When I was down in Florida at that conference, the debt coverage ratio is now more important than the cap rate because the banks cannot determine what the cap rate is in their markets. It's a moving target. Even the appraisers are having trouble determining the cap rate because it's moving so fast. So the banks only look at the debt coverage ratio. What can the property support based upon the loan to value, based upon the interest rate, based upon the term? So that all ties back into, and also based upon the NOI, that all ties back into the debt coverage ratio. So this is now really, in today's market, because of what's going on, you need to be comfortable with the debt coverage ratio more so than with the cap rate. Just remember, the DSCR is a dynamic number. It's your sleep number. The larger the number, the easier it is to sleep at night. And it changes based upon the quality of the asset. And let me see let me just jump over. Okay. And here's what I mean. Nice properties have very nice tenants who pay their rent on time. So as a result, you as the owner of the property can take on a little bit, well, I wouldn't say you don't have to take on as much risk because the tenants are such good risks. So therefore you can go with a lower debt coverage ratio. Now the bank will lend you money at 1.2. And back during the last heyday, you could get one for 1.15. It's interesting. I was looking at the loan documents for the Nashville YMCA, and they do a 1.1 debt coverage ratio. The banks will lend to the Nashville YMCA with a 1.1 debt coverage ratio. And the reason is because it's a nonprofit. They don't have to show a profit. And so they can go with a lower debt coverage ratio. If you go, but we have to pay our capital expenditures, and we have to pay our, capital expenditures, the bank always puts that number above the line, but we have to pay our investors. So we have to be able to build that number into our calculations so that the debt coverage ratio takes that into consideration. So the bank will do a 1.2 debt coverage ratio. Don't do it. Don't be that guy. And here's why. The bank is in the driver's seat. They can afford to do a 1.2 debt coverage ratio. You can't. See, because if what 1.2 means, every $1.20 that property generates in income, the first dollar goes back to the bank, gets paid to the bank. The rest is for you to pay everything else to your investors, CapEx, or what have you. That's not enough money. So even if it's a nice property, like a class A property, and you know your tenant's going to pay on time, a higher debt coverage ratio is still important. You don't want to run that risk. 1.3. Remember, I just got done saying you're out of cash, you're out of business. Same thing here. So buy yourself that protection. Don't, and it all ties into the purchase price and also loan to value and what have you. But only do a deal when you've got a nice, comfortable sleep number in the form of a DCR. Tougher properties have tougher tenants who don't pay on time, and therefore you as a business owner need to protect yourself against that. And so you structure the deal so that your debt coverage ratio is a 1.6 or higher. Now, remember, you got all these problems going on right now where the sellers are not coming down on their purchase price like we think they should, because they still think everything's going fine. But the problem is interest rates are going up. So the interest rates are the ones forcing the sellers to have to reduce the value of their property because the interest rate takes into consideration the debt coverage ratio. So as the interest rates go up, the money becomes more expensive and that debt coverage ratio gets tighter and tighter. The only thing we can do to fix it is to reduce the purchase price. So that's what's going on. These numbers are moving in perfect symphony to make sure that the deals get moved out the door, because the banks only make money with the movement of money. And so they got to make these deals, flow. And the fastest way to get a seller to understand that his baby is not as pretty as he thought it was is to increase the interest rates. I mean, I'm saying that as if that's how they control it, but that's what's going to happen. The seller's going to come to that realization that they have to do something. Banks don't care. They just take the collateral. If you can't afford a 1.2, sorry guys, we're taking the property. You get nothing. So don't settle for a low debt coverage ratio because the banks say, hey, you qualify, congratulations. You're at a 1.2 debt coverage ratio. You don't want to be at a 1.2. Don't do the deal. Get a good night's sleep.